Hey, welcome! Today, we are pulling back the curtain on the world of finance. But we're not going to be looking at boring spreadsheets or stock charts. Nope, we're talking about the human and sometimes not so human psychology that drives billion-dollar decisions. We're talking about the hidden rules of the game. And to really get these rules, we're going to start with a genuine mystery. See, on paper, an open option seems like the absolute fairest, most transparent way to price a company's big debut on the stock market. You know, its IPO. But in the real world, they almost always fail, spectacularly. So why is that? And get this isn't just some small, quirky thing, it is a massive global pattern. As researchers Jagannathan and Sherman pointed out, country after country has tried to make these auctions work, and pretty much every single one of them has just thrown in the towel. Something is fundamentally broken. To solve this puzzle, we need a whole new way of looking at it. We have to see finance not just as a market of numbers, but as a high-stakes strategic game. And the perfect tool for that? It's called game theory. So what is it, really? Well, at its heart, game theory is all about situations where my best move depends entirely on your best move, and your best move depends on mine. It's all about strategy. It's not just about what I'm going to do, it's about what I think you're going to do in response to what you think I'm going to do. See? It gets complicated fast. And a really key idea here is something called the Nash equilibrium. Just think of it as the no regrets point in a game. It's that stable spot where every single player is making the absolute best move they can, given what everyone else is doing. At that point, nobody can do any better by switching things up on their own. All right, so we have our tools, we have our mystery. Let's put them together and see if we can finally crack this case of why those supposedly fair IPO auctions are just doomed from the start. Okay, first, let's look at where auctions do work beautifully, like for government bonds. Those auctions happen all the time, the bonds are pretty easy to value, and it's the same core group of pros playing every time. IPOs, they are the exact chaotic opposite. They're rare, one-off events. Valuing a brand new company is incredibly hard, and the players are different every single time. This just creates a massive fog of uncertainty. And all that uncertainty leads straight into a classic game theory trap, the winner's curse. Imagine you win an auction for a sealed jar of cash. The very fact that you won is a pretty strong signal that you probably paid too much, right? Because you were the most optimistic person in the room, and probably way too optimistic. In an IPO auction, the winner is often just the person who is most wrong about the company's value. Then you've got the free rider problem. So picture this. You're a super serious investor. You spend weeks, maybe months, doing deep research on a company. But in the auction, some casual bidder who's done zero research can just throw in a crazy high bid, knowing that they'll only have to pay the lower price set by informed folks, like you. They get a free ride on all your expensive hard work. So you have to ask yourself, why would you even bother to play that game? And right here, this is the aha moment. The winner's curse scares away all the sensible, cautious investors. And the free rider problem basically tells the smartest, most informed investors to not even show up. The whole auction just becomes unstable and collapses. So you see, the failure of IPO auctions isn't some deep market flaw. It's a perfectly logical, predictable outcome of the rules of the game. So here's the crucial takeaway. This isn't just about IPOs. Not at all. These strategic games, games of information, of signals, of trust, they're being played everywhere in finance, all the time. Okay, let's take a signaling game. When a company pays out a big dividend, that isn't just a simple payout, it's a strategic move. The company is the sender. The big, costly dividend is the signal. Why costly? Because a weaker company couldn't afford to fake it. Investors are the receivers, and when they see this, they update their beliefs. They think, wow, only a really healthy, profitable company could afford to do that. And their action? They start buying the stock. The message gets sent and received, loud and clear, without a single word. And that's just one example. I mean, these game theory models, they explain so much about finance. The classic prisoner's dilemma can help us understand why banks might struggle to cooperate during a financial crisis. We just saw how signaling games explain things like dividends. And repeated games, they show us how crucial things like trust and reputation are built over the long haul. It's an absolutely powerful toolkit for understanding why people do what they do. But here's the twist. The game is changing. The players, the rules, even the whole playing field itself is being completely transformed by technology. Yeah, we're not just talking about human traders and bankers anymore. Now we have AI agents that can learn and adapt their strategies faster than any human ever could. We have decentralized finance, DeFi, which runs on blockchains where the rules are literally baked into the code, not some legal contract. These aren't just new tools, you guys. They are entirely new players joining the game with completely new playbooks. And all of this leaves us with a really fascinating and maybe kind of scary question for the future. When the players in the market are algorithms and the rules of the game are written in code, who is really setting the rules anymore? And maybe more importantly, who is actually winning?